Discipline in trading is not about forcing yourself to take trades. It is about refusing most of them. This is the part no one wants to accept. The inspection stage is quiet, repetitive, and unrewarding to the ego. Nothing exciting happens there. No profits, no validation, just judgment. This is where traders either mature or disappear. Every market session presents dozens of possibilities. Most of them are noise, weak structure, poor timing, emotional temptation dressed up as opportunity. Discipline is the ability to look at all of it and say no without hesitation or regret. Low-quality trades are seductive. They feel almost right. They promise action. They relieve boredom. They create the illusion of productivity. That is why they are dangerous. The inspection stage exists to stop them. A professional trader understands that rejection is not failure. It is protection. Every trade you do not take preserves capital, clarity, and emotional balance. Every unnecessary trade avoided is a win that does not show up on a statement. Amateurs want to trade. Professionals want to trade well. Discipline is not emotional restraint in the moment of entry. It begins before that. It begins with standards. Clear, non-negotiable criteria that decide whether a trade even deserves attention. If a trade does not meet the standard, it is discarded immediately. No discussion, no adjustment. No almost. Almost is poison. Most traders lose money not because they break rules during trades, but because they allow bad trades into the system in the first place. Once a low-quality trade is active, discipline is already compromised. Emotion is now involved. The real work was supposed to happen before the entry. Inspection is uncomfortable because it requires honesty. You must admit that most of what you want to do is unnecessary. You must accept that your desire to act is not evidence of opportunity. The market does not care if you are ready. It only cares if conditions are. Traders who struggle with discipline often believe they need more confidence. What they actually need is higher rejection tolerance, the ability to watch moves happen without participating, the ability to miss trades without feeling diminished. That strength is rare. Inspection also requires consistency. Standards cannot change based on mood, recent losses, or excitement. The market will test this relentlessly. It will offer just enough movement to tempt you into lowering the bar. Lowering the bar always has a cost. When you consistently reject low-quality trades, something changes internally. Urgency fades. You stop feeling pressured to be involved. You start trusting that real opportunities stand out without effort. This trust is built through repetition. Discipline is not heroic. It is boring. It is repetitive. It is saying no when nothing is wrong with saying yes, except that it doesn't meet the standard. The market does not reward discipline immediately. It rewards it eventually. Those who cannot tolerate delayed validation abandon inspection and chase action. They are processed quickly. The trader who survives understands this truth. Most money is made by what you refuse to do. Discipline is the gate. Everything that passes through it determines the outcome. Patience in trading is often misunderstood. Many believe it means sitting back passively doing nothing, hoping something happens. That kind of waiting is weak. It creates restlessness. It builds frustration. It eventually collapses into impulsive action. Real patience is controlled waiting. Controlled waiting is active restraint. It is awareness without interference. It is watching price move without feeling obligated to participate. It is knowing exactly what you are waiting for and refusing to act until it appears. This form of patience requires structure. Without structure, waiting becomes doubt. Doubt turns into second-guessing. Second-guessing turns into forced trades. Traders don't lose patience because time passes. They lose patience because they don't know what they are waiting for. Clarity creates patience. When your criteria are clear, waiting has purpose. Every candle that does not meet your conditions is automatically irrelevant. You are not missing out, you are filtering. The market spends most of its time in states that do not pay. Sideways movement, false breaks, emotional noise. Traders who cannot wait mistake movement for opportunity. Movement is cheap. Opportunity is rare. Controlled waiting accepts boredom as part of the process. Boredom is not a signal to trade. It is a signal that nothing is required of you. Traders who fear boredom manufacture trades to escape it. The market punishes that fear. Patience also means allowing trades time to work once you are in. Many traders enter correctly and exit incorrectly. They panic at the first sign of discomfort. They interpret normal fluctuation as danger. This is not caution. It is impatience wearing a disguise. Correct patience trusts the plan more than the moment. It accepts temporary discomfort in exchange for structural advantage. This is impossible when size is too large. Oversizing turns waiting into suffering. If waiting feels unbearable, reduce size. Patience is not about enduring pain. It is about removing unnecessary pressure so endurance is not required. Professional traders do not wait heroically. They wait comfortably. Comfort is created through preparation and restraint. Hesitation is different from patience. Hesitation comes from uncertainty. Patience comes from certainty. One delays action because of fear. The other delays action because conditions are not aligned. Knowing the difference matters. Hesitant traders miss trades they should take. Impatient traders take trades they should not. Both are symptoms of poor process. Controlled waiting corrects both. The market will test your patience by offering partial signals, almost setups, close calls. These are designed to pull you in early. Acting early feels proactive. It feels smart. It is usually expensive. Waiting for confirmation is not conservative. It is precise. Precision is what separates survival from exhaustion. Traders who master patience stop feeling rushed. They stop feeling behind. They stop reacting to every move. They begin to see the market as a sequence of filters, not a constant opportunity. Waiting becomes work, and work becomes quieter. The market does not reward speed. It rewards timing. Patience is how timing is achieved. Every professional process produces waste. That truth is unavoidable. What separates mastery from chaos is how that waste is handled. In trading, losses are the waste. They are not evidence of failure. They are the cost of extraction. But when waste is unmanaged, it poisons everything downstream. Most traders don't lose because they take losses. They lose because they let losses spread. A measured loss is information. It is clean. It has boundaries. It ends where it is supposed to end. A contained loss leaves the trader intact, focused, and capable of making the next decision without distortion. An unmanaged loss does the opposite. It leaks into behavior. It bleeds into the next trade. It creates urgency, defensiveness, and the need to compensate. That need is where discipline collapses. Losses must be accepted before they occur. Not emotionally accepted after the fact, but structurally accepted in advance. When you enter a trade, you must already know exactly how much waste you are willing to produce. That number is not negotiable once the process begins. The moment you negotiate, containment is lost. Most traders understand stops conceptually. Few respect them psychologically. They place stops but don't believe in them. They move them. They justify them. They delay them. This is not analysis. It is avoidance. Avoidance turns small losses into large ones. Large losses damage confidence. Damaged confidence leads to defensive trading or reckless trading. Both generate more waste. This is a system failure. Contained losses preserve trust. Trust in the plan. Trust in execution. Trust in self-control. When losses are measured and honored, the trader knows they are operating within a controlled environment. Control reduces fear. Losses that are too large, too frequent, or emotionally charged create trauma. Trauma does not teach lessons, it creates reactions. Traders then trade to avoid pain rather than to execute opportunity. This is how the mind becomes the enemy. Professionals treat losses with indifference, not because they don't care, but because they are expected. They do not personalize them. They do not dramatize them. They do not seek meaning beyond what the data provides. A loss is either within plan, or it is not. If it is within plan, it is acceptable. If it is not, it is a process violation. Only one of those requires correction. Many traders spend years trying to eliminate losses. That effort is wasted. Losses cannot be eliminated. They can only be managed. Energy spent resisting loss is energy not spent refining execution. Containment is refinement. This is why position sizing matters. This is why daily limits matter. This is why stopping after emotional dharma, GE, matters. These are not restrictions. They are safeguards that keep waste from overwhelming the system. The market will always demand payment. You decide how much and how often. A trader who contains losses stays objective. They remain selective. They maintain patience. A trader who allows losses to expand becomes reactive. Reactivity is expensive. Losses are not the enemy. Uncontrolled losses are. Waste is part of the process. Spill is optional. The trader who learns this stops fearing loss and starts respecting it. That respect keeps the process clean and the mind clear. Overtrading is not a problem of opportunity. It is a problem of control. It happens when input exceeds capacity. When too many trades are forced through the system, quality collapses, clarity disappears, and errors multiply. A processing system can only handle so much at once. The market offers endless movement, but your mind does not have endless bandwidth. Every trade consumes attention, emotional energy, and decision-making power. When trades pile up, those resources thin out. That is when mistakes begin. Overtrading usually starts quietly, one extra trade, then another. Each one feels justified in isolation. Together they create overload. The trader stops evaluating properly. Trades are entered faster. Exits become sloppy. Risk management weakens. The system is flooded. Flooding destroys output quality. Even good setups lose effectiveness when taken in excess. The trader cannot manage multiple positions with the same precision. Focus fragments. Discipline erodes. The market did not change. The trader overwhelmed themselves. Most traders overtrade because they are uncomfortable with stillness. They equate activity with effort. They believe that if they are not trading, they are wasting time. This belief is false. Trading is not production work. It is selection work. Value comes from choosing, not from doing. The hardest part of trading is not pulling the trigger. It is resisting the urge to pull it unnecessarily. Overtrading is often driven by emotion, boredom, frustration, the need to recover losses, the desire to feel involved. These emotions push trades into the system that were never meant to be there. Once inside, they contaminate everything. Frequency magnifies small errors. A slight edge disappears when execution quality drops. Costs increase. Focus weakens. The trader becomes busy but unproductive. Busy is not effective. Professionals understand that fewer trades done well outperform many trades done poorly. They are comfortable with low volume. They do not need constant stimulation. They respect the limits of their attention. Overtrading also distorts feedback. When too many trades are taken, it becomes impossible to know what is working and what is not. Results blur together. Learning slows. Flooding prevents refinement. The solution is not more discipline in the moment. It is structural restraint, clear limits on how many trades can be taken, clear criteria for participation, clear rules for stopping. Stopping is critical. The moment emotional intensity rises, input must be reduced. Continuing to trade while compromised guarantees deterioration. Professionals shut the system down when quality drops. Amateurs push harder. The market rewards those who protect their process. Overtrading is a violation of that protection. It sacrifices long-term consistency for short-term activity. Activity feels productive. Consistency is productive. When trades are limited, focus sharpens. Each decision matters. Execution improves. Patience increases. Waiting becomes natural again. Flooding removes all of that. The trader who learns to trade less gains more than money. They gain control. Control over time. Control over emotion. Contra. OL over outcome variability. Overtrading is not ambition. It is lack of restraint. Restraint is what keeps the system clean and the output pure. Most traders believe the market shapes them by reward. They think profits teach the lesson. They believe winning reinforces good behavior. That belief is comforting and wrong. The market refines by removal. It removes bad habits. It removes weak ideas. It removes impatience. And if you resist long enough, it removes you. The refining process is subtractive, not additive. Nothing is given until something unnecessary is taken away. This is why trading feels painful before it feels clear. Pain is the signal that something is being stripped. The trader who grows is not the one who gains more tricks. It is the one who loses illusions. Illusions of control. Illusions of certainty. Illusions that effort guarantees reward. The market does not reward intelligence. It removes arrogance. It does not reward activity. It removes impulsiveness. It does not reward confidence. It removes overconfidence. This is why early success is dangerous. It delays removal. It reinforces behavior that has not yet been tested by stress. When removal finally comes, it comes violently. The trader is confused. They thought they were doing everything right. They were not being refined. They were being spared. Losses are not punishment. They are extraction. They pull out what does not belong. Every losing trade exposes something unnecessary. Poor timing, emotional entry, oversized risk, lack of patience. If you pay attention, loss shows you what to remove. Most traders do the opposite. They add more indicators, more trades, more size, more opinions. They attempt to overpower the process with complexity. Complexity hides weakness. Removal exposes it. Professional growth happens when the trader simplifies. Fewer trades, clearer rules, smaller sizz. E. Less noise, less need to be right. This simplification is not comfort. It is discipline. Discipline hurts because it removes options. The market forces this removal whether you cooperate or not. If you refuse to let go of bad habits voluntarily, the market will remove capital. If that does not work, it will remove confidence. If that still fails, it removes participation entirely. This is not cruelty. It is selection. The traders who survive are those who learn to remove first. They eliminate low-quality trades before the market punishes them. They reduce size before fear forces them to. They stop trading before damage spreads. They do not wait for pain to do the work. Reward is misleading. Reward comes late. By the time profit arrives, the refinement has already happened. The market never says, do more of this. It says, stop doing that. Listen carefully. Every frustrating period is asking for subtraction. Every drawdown is pointing at excess. Every emotional mistake highlights something that should not be there. The market does not refine gently. It refines effectively. Those who accept this stop chasing reward and start removing weakness. They stop asking what they can add and start asking what must go. That question changes everything, because once enough is removed, what remains no longer needs force. It works naturally, cleanly, quietly. The market does not build traders. It carves them. Self-control in trading is not a moment of strength. It is not a single decision to behave correctly. It is a continuous process of filtration. Every second the market is open, information flows in. Price movement, news, opinions, internal reactions. Most of it is useless or dangerous. If it is not filtered, it controls you. Emotions do not appear once. They cycle. Fear fades and returns. Confidence grows and mutates into arrogance. Frustration quiets down and resurfaces as urgency. Self-control means recognizing these states and preventing them from reaching execution. The mistake most traders make is trying to suppress emotion. Suppression fails. Emotion will surface whether you invite it or not. The goal is not elimination, it is containment. Containment is filtration. Before any trade is placed, emotion must pass through rules, clear criteria, risk limits, time constraints. If emotion cannot pass through these filters, it does not reach the market. This requires structure. Structure creates distance. Distance allows evaluation. Evaluation prevents impulse. Without structure, emotion flows directly into action. Action driven by emotion is almost always expensive. Impulse feels decisive. It is rarely precise. Self-control also means filtering external noise, other traders' opinions, headlines. Seal commentary. None of this improves execution. Most of it destabilizes it. The disciplined trader limits input deliberately. Information is not edge. Interpretation is. Filtration is ongoing because emotion evolves during trades. An open position changes the internal landscape. Hope appears. Fear fluctuates. Greed whispers. Self-control requires constant monitoring. This is exhausting when size is too large. Correct sizing makes filtration possible. When risk is manageable, emotion is quieter. Filters do not clog as quickly. Decisions remain deliberate. When size is excessive, filtration fails. Emotion floods the system. Reaction replaces execution. Self-control also includes knowing when filtration has failed, when emotions are leaking into decisions, when impatience rises, when revenge thinking appears. At that point, the correct action is not better control, it is withdrawal. Stepping away is not weakness, it is the final filter. Professionals shut down the process when integrity is compromised. They do not test their limits in live conditions. Amateurs do. The market does not reward those who push through. It punishes them for ignoring internal signals. Fatigue, frustration, and overconfidence are warnings, not challenges. Filtering requires humility. You must accept that your mind cannot handle everything. Limits are not flaws. They are boundaries that preserve performance. The trader with strong self-control is not rigid. They are selective. They do not react to every stimulus. They allow most of it to pass without engagement. This creates calm. Calm creates clarity. Clarity is the environment where good decisions are made repeatedly. Self-control is not visible on a chart. It does not announce itself, but it determines everything that follows. The market is not chaotic. Unfiltered minds are. Those who learn to filter survive. Those who do not are overwhelmed by their own impulses. Self-control is not about being strong once. It is about being vigilant always.